Thank you, Mabrouk, for joining us. How do you see the global markets outlook over the coming months?
Well, thank you for your question. We remain pretty constructive on the equity market and more specifically on the US equity market, because we do believe that next year the equity market in the US will be supported by a strong policy mix. The Fed will deliver, the big beautiful bill, the fiscal policy will also contribute positively to the business cycle in the US. And at the end of the day, the US equity market will benefit from these two factors. When it comes to the bond market, as I said, the momentum for growth is quite positive, so it should maintain interest rates at the current level. So we do prefer to take risk by being invested on the equity side rather than the bond side. Same thing in Europe. In Europe, there is a positive momentum for growth. Growth is expected to be higher in Germany in particular, and it will support the level of interest rates, which is not supposed to decline. And this is why there is nothing to expect in terms of performance for the bond market compared to the equity market, which is, in our opinion, more rewardful for the portfolios. So being more exposed to the equity market rather than the bond market for the next year. At last but not least, we need to say a few words about the US dollar, because it has been extremely painful for European investors to have US assets last year, in 25, because the US dollar has depreciated quite significantly. What is the direction of travel that we expect for the greenback? We do think that the US dollar will remain quite unchanged at the current level or should appreciate, which will be another support for the performance of foreign investor, European investor, when they have acquired US assets.
Okay, thank you so much, Mabrouk.
You're welcome. Thank you very much.